Welcome to another episode of Breakaway from the Rat Race. And today I have the pleasure of speaking with Drew Breneman. Drew bought his first rental property at age 19 with money earned from an internet business he started while in high school. His first purchase really attracted the attention of HGTV, dubbing him as an up-and-coming real estate investor. He successfully navigated the 2008 financial crisis by purchasing discounted commercial properties and then shifted to undervalued and mismanaged multifamily residential assets. Drew is also the host of Breneman Blueprint podcast, and he's the owner of Breneman Capital, where he utilizes data to navigate the current investment landscape. And we all know I love data. Drew, welcome to the show.
That's right. Thanks, Eric. Thanks for having me on. Appreciate it.
So this is very exciting. So I'd like to start with internet business and then kind of like converting that into real estate. Why the shift from something that sounds so cool to have like an internet business and then go into something so old-fashioned as real estate?
The internet business was more, it was probably more, people use the term now as more of like a side hustle where over a course of 4 years, I made some serious money, but on an annual basis, it wasn't a lot. But while I was in high school and then I continued it through freshman year of college, I made between $80,000 and $100,000. And so as an adult, that would have got you nowhere. But as a high schooler, I kept it all. I didn't spend any of it. So then I was able to really set myself up for future success. And I started looking at what should I invest this money in. And yeah, that's where I came into real estate, where I looked at how the stock market worked and mutual funds and trading options and buying tax lien certificates, all these different strategies. But I just really liked commercial real estate, multifamily rental properties. It just had so many great attributes where you have cash flow, you make money just by paying your loan down. So even if you feel like there's not a lot of cash flow, you're still making money every month, paying your loan down, the building's going up in value. You get tax breaks. Like it isn't that correlated with other investments. Yeah. So it made a lot of sense to me even as a teenager.
Yeah.
And just sort of fell into it, for lack of a better term. I didn't have anybody that I knew who was investing in real estate as a kid. I'm
you had to figure it out yourself.
Yeah, my parents were both teachers. My dad is they're retired now, but was a shop teacher, so woodworking and automotive. So, if you ever need anything, we like built all of our furniture in our house, and we've never spent any money pretty much on any car maintenance labor because we can do it in the driveway for free. Or when he was at the school, put it on the lift. And then my mom was a speech pathologist. So yeah, they're not into business, but they were really supportive, where they weren't telling me don't do this, where, I do see people, buddies or whoever, where their parents will tell them, like, I think that's a bad idea. And they're really kind of trying to steer their kid a certain direction, to be a doctor or whatever, or engineer. My parents didn't do that. They just were, obviously they wanted me to go to college and, not just like drop out, let's say, but they weren't telling me this is a bad idea. But at the same time, it wasn't like they were throwing money in the deals and or saying, well, hey, why don't you do this? It was more, it was all my own idea, but it was really sort of making that money in high school. Really, it didn't force me to do it. I just wanted to do it, where I started reading the books that people normally read when they're like 40. I read Rich Dad, Poor Dad when I was like 15 years old, probably.
Oh, wow.
And in those kind of books, I did a book report on Think and Grow Rich when I was a junior in high school. I remember thinking, let's work smarter, not harder here. And I'll kill two birds with one stone. Everyone says, read this book, and I need to do a book report. So that really kind of, that one thing that when I think about it, and I don't know, where I'm really fine with making sacrifices and delayed gratification. So if I had to chalk up like those early years, what sort of set me up for that, where, it was kind of like a grind doing the internet business, where I'm delivering these items in this game. I don't make a lot in any one sale, maybe like $5 to $10, but I did thousands of them.
Yeah.
And so where I had, so I just grinded it out, saved the money, and, I'm still sort of that money that I invested in those properties. It's still in deals I own today, where I, in 2017, I sold the last one that I owned that I bought in college, did a 1031 into two larger deals at the time. It felt like in Chicago, and then I still own those two deals. So like I'm still delaying the payoff, so to speak, on that internet business money. It's still sitting in 2 6 units in Chicago right now for the most part.
Yeah, I mean, there's a significant advantage, like when you get started very young, is that I also started young with my first investment, and you kind of like, what do I have to lose? Like, even if this thing really, craps out and it's really horrible, and I lose everything, that's okay because I really didn't have anything in the first place. So what am I going to lose?
You're
My house, my car? I don't have any of that, and my
you're
bank.
right.
Yeah.
Yeah, you're right. That was my mentality to some extent, where it was all my own money. So I'm definitely down to take chances and learn this thing. And,
Yeah.
I think it's, when you start taking on investors like I do now, it's like a whole nother ball game. But starting out, if you're investing just your own money, it's this time you need to learn a little bit and just get going. Cause yeah, you're going to learn a lot more by doing. So those, and agree with you. I have the same sentiment and tell people the same thing about quitting their jobs. Like, if you're on the fence right now listening to this about quitting your job, the worst case scenario is you just go get the same job but at a different company in a couple years if your thing doesn't pan out. It's not that bad.
Yeah, you live with that, or you live with the regret for the rest of your life. So you decide what's best for you. But
Yeah.
and I think this is important because as you get older too, like you have, I mean, you end up with more responsibility. Of course, you have a family, and then you get into situation where you have a mortgage, all that kind of stuff, and then your expenses are super high. When you're younger, you're more not necessarily frugal, but I mean, your expenses are very extremely low. And the trick is really to keep yourself nimble throughout your life so that you can, or as nimble as possible, so that you can easily make these kinds of investments that are going to, bring you cash flow, bring you appreciation, and really build your wealth that way. And it's to stay a certain level of frugality throughout your life so that you really maximize the return on your investment.
Yeah, it's spot on. I think maybe I'll explain kind of what I did after college because it just
Yeah.
mirrors exactly what you're saying. So I bought those 4 deals. It was 2007 in December when I graduated college. Had already invested my own money. I didn't really think about raising money. I didn't know anybody to go to, or hadn't heard about that really. I had a real estate degree. So I went to college at UW-Madison in Wisconsin, and in their business school, they have a real estate track, a real estate program. So I majored in that. So my degree's in real estate. And then, so I figured, why not get a job, see how these like bigger companies are doing it. To this point, I only have really learned on my own and then reading a couple books, from the library. So then why don't, so I interned at an office developer for, 6 to 9 months or so, 1 year. And then, after I graduated, I worked at an apartment company in Minnesota. And while working there, I lived in, they had a discount. If you lived in some of their buildings, they would give you a discount. It wasn't in the trophy nicest ones, but what I was paying after the discount, I think it was normally like a $1,200 apartment, but they discounted it down to like $850. So, I mean, most, that's pretty cheap living. My car was $1,000, the same one I had this whole time for the most part. And then when that had a lot of miles on it, so I had to buy another one. But I bought, another car for a different Pontiac Grand Prix for $8,000. And then and so also too, like a lot of people, they'll go, oh, I'm making money now, I have these rental properties, I'll go buy a Mercedes and I'll borrow the money.
Lamborghini, everybody wants a
So
Lamborghini. Like,
yeah. So instead, I didn't waste money on that stuff, for the most part. So the next car I bought, it was $8,000. I just wrote a check for the difference, and so there's no car payment. I'm spending $800 on rent, and not doing, not spending a lot. And then while I was working there, I met a father and a son, the guy who was interning at the same company, and those became my first partners on the bigger deals. Okay. So then me and the son and father, we started a company, and we bought about $100 million of property together the next 10 years. But I still kept it super frugal that whole time. So then I switched jobs. So I moved to the Chicago area. But I same thing. I lived in like $1,000 a month place. And then once I worked there until 2011, and then when I quit, moved back to Wisconsin just for a year and lived in my parents' house just to extend my runway
Yeah.
time wise. I already at that point, I was an owner in $25 million of property at that moment when I quit, where I had at that point 2 deals still on my own in Madison. I had sold 2, kept 2 out of the 4 I bought.
Yeah.
And then we had already bought 5 larger deals in Minnesota with this family, and then had a 6th one on the way.
Yeah.
So, I could have started spending money, but instead I'm like, let's extend the runway, live with my parents. They're not charging me anything to be there. I just chipped in like on utilities, so it wasn't much. And then, so I kept my overhead really low, and I had like a spreadsheet, like how long can I live just on my savings?
Yeah.
And, it was at the rate I was going, I was spending pretty much nothing. So, it was like a 10+ year runway if you want to live like a college student forever.
Yeah. 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 So so you started, I mean, at which point, let's talk about 2008, because I think maybe is that where kind of like things started accelerating a little bit? You mentioned like 2007 when you started this investing with the father and son kind of thing, if I remember correctly. And then and then 2008 kicked in. So what was going on through your mind before you realized that the whole thing was like gonna unravel? And then how did you take advantage of that on the back end?
Yeah. So the first 4 deals that I bought in school, those were 2005, bought 2, 2006, 2007. So my timing on those was really bad in terms of from a market timing standpoint. One thing fortunate for me, I was investing in student housing. So the value dropped when, everyone's valuations, the people got more conservative with what they would pay, but my rents didn't drop. I was able to raise them for the most part every year. Not a crazy amount, but slowly over time raising them, because there's some of these asset classes like senior housing, student housing, some say self-storage. Those aren't really that impacted by the broader economy. So what I learned on those deals was you got to just hold them. I thought about selling them when those last 2, in 2009, 2010, but I would have just sold them for enough to pay off the debt and walk away with nothing. So I kept them and ended up making money on both of them, and really good money on one of them. And so in 2008, I met the family up in Minnesota, and then what we focused on. So we're looking at all the distress in the market. So the market in 2009, 10, it's easy to think now like, wow, you could have bought anything, you would have crushed it. But just to lay the groundwork on what it was like buying at that time, the second deal we bought was a shopping center, and one of the tenants was Wells Fargo. And while we're buying it, we're literally watching the TV on CNBC to see if Wells Fargo is going to go out of business or not. That was the talk. It was like, it's either going to it's basically make or break it for this week at Wells Fargo. And they survived, obviously, and we bought the deal. But that's how bad it was. So what we focused on, we were trying to find multifamily deals, both the son, Brian, and I, we worked at a multifamily developer. So we knew multifamily, we wanted to buy that. But there wasn't really anything that we saw selling that was multifamily of any quality, because there wasn't that distress sort of operationally, where people's rents, they had dropped some, but it wasn't enough where it was a fire sale time. And then it wasn't, there wasn't a lot of debt maturities. Everyone had agency for like the biggest lender in multifamily is agencies, Freddie, Fannie, HUD. And so a lot of people were, it's Ren 5 and 10-year fixed loans, and they're like, I got 8 more years of loan term, I'm good, I'm still cash flowing, I don't need to sell. So we focused on were commercial deals, so shopping centers, industrial deals. We bought one office building where they were somewhere between, let's say, 80 and 100% occupied. The rents were, so buying that way, it's cash flow positive day one, and the rents are at market or below market, which sounds obvious, but was extremely difficult to find at the time, because basically most all leases were over market at that point, because you signed a lease in 2007. By 2009, rents had cratered. So most of the shopping centers you look at, the rents, they're getting $30 a foot, market's 22 now. And kind of thing. So we focused, rents at market today, and then a long enough lease term to get us out of the storm. So like the first deal we bought, it was Verizon Wireless, and then like a high-end tanning business called Dark Tan. They both had 7-year leases in place, moving into a brand new building that was delivering in 2008. So they were paying market rents, not some overinflated thing.
Yeah.
And we bought that at, I think a high 8 cap at the time, borrowed at 5.5. So we were getting paid to wait. So we were getting a lot of cash flow. You pay a lot of debt down on these commercial deals because they're 25-year amortizing loans.
Yeah.
And so the one thing that was nice too, from like just in terms of executing the deals, is we only had really one investor. So it's just as simple. It's not like some of these groups where you got to send it out to 100 people. You're not really sure what's going to happen. This, you just show it to them ahead of time. This is what we want. The dad had a construction background, so newer, nicer he liked. So that first deal being brand new and in a really good neighborhood, he liked it. Cash flow was strong. And by 2015, obviously this will be in a totally different place with the economy. And both tenants renewed in 2015, for example. So that's been a nice. That deal, actually, we have, if you want to talk about the power of just long-term investing, we still own that deal. And just in terms of money paid out to date and still owning it, we've already 4x'd our money with not including selling it.
Wow.
So that's been a really strong performer
That's amazing.
For us. We did have Verizon move out, so we got to get that backfilled now. But that, which is one of the negatives with commercial, where it's up and down. We had a really strong, I guess it would be 12-year run with that, but now it's not going to make any money till you fill that vacancy up.
Yeah.
So,
and this is great that you're talking. We're kind of like talking about 2008. People are looking at 2008 and they're thinking, oh, it was easy. The market was down at the time. You bought it, and then of course it went up. But it sounds easy when you're looking backwards and you're looking back and you're saying, yeah, of course now it's obvious. But when you were in the thick of it, it was not the same thing. I mean, it was risky. Is it going to continue to go down? There was also difficulty getting loans, if I remember correctly. I mean, the interest rate was super low, but then to qualify for the loan and to have a bank actually lend you money was pretty difficult. Also,
it was.
Yeah,
it was. And it also, most buyers were just, they couldn't do anything because they had so many deals they already bought they're having problems with. So they weren't thinking about investing in new deals. They're thinking about adding money to their existing ones.
Yeah.
And then, a lot of borrowers, they'd send the bank with their personal financial statements, schedule real estate, and they have a lot of issues in their portfolio. So they don't want to get the banks don't want to lend them more money. Where I was very fortunate, where my investor, he owned only one other property that was a commercial one that was his business was in. And then all of us signed on the loan. So he was able to put his, that's why I call him more of like a partner, where, and same thing with the son, where they weren't just only throwing in money. If the deal had some construction questions, the dad was helping out. And then same thing with being on the loans. So we had 3 people essentially with no commercial real estate, bad loans on their books, the 3 of us. So then we at the time looked, even though we were young, we were looked at as really good borrowers because we're buying a cash flow positive deal with good rents in place, long lease term. And then we don't have any, skeletons in the closet like all the other borrowers did. So, yeah, I mean, if people want to apply something today, I mean, at the time, it was really hard to make anything sort of look like it made that much sense. Where one thing when you're underwriting, you buy at 1 cap rate, let's say today, which is how properties are valued. Then to underwrite appropriately, you sell at a higher cap rate. That's how everybody underwrites, where you don't assume the same cap rate or a lower one. But so as cap rates go up, which as they are now, you then need to assume they are up even higher when you sell. So even though you're buying at a higher cap rate than 12 months ago, your numbers don't look that great today because let's say it's a multifamily deal and you're buying it at a 5.5 cap. Well, you're also borrowing at a 5.5, and then to underwrite, how they say and not how it's, by industry norms. Now you need to sell it at like a 6 cap or a 5.75% cap rate. And so, and if you're not familiar with the cap rate, I mean, it's basically just, you're dividing the NOI by this percentage. It's similar to like a multiplier on income on a business. But so what I'll say now is, like, if you can make any sense of a deal and buy it in 5 years and 10 years, like, so if you can buy it today, it's going to look like a really great deal.
Yeah.
Prices are down, depending on where you are, 10 to 30%, and depending on what kind of property. But if just generically, if I were to say how much are they down, they're down that much. So that's going to look like a good purchase once we get on the back side of this. The thing is, right now in your spreadsheet, your numbers, it doesn't look that exciting. It makes 5.5% if it had no debt in it, but I borrow at 5.5%, and my cash flow is like 2% out of the gate.
You're lucky you're buying it. You're lending, you're borrowing at 5.5%. Often your borrowing cost is a little bit higher than 5.5% even. So.
Oh yeah, I guess I'm talking on the multifamily deals that I do. So call it 20 plus units. You can get a Fannie 5-year loan right now in the mid 5s. But you're buying a rental house, duplex. Yeah, rates are higher, but hopefully also your cap rate's higher, and that's still sort of
a little bit higher.
Makes sense. But point being, the returns are really compressed. And if you're buying today, what you have to be assuming is interest rates are going to drop. I'll be able to refi into a better loan later. And when rates drop, people will begin paying lower cap rates again. And then this will end up turning out really well. And that's what happened in 2008, 9, 10, 11 with all those deals we bought. We bought them at 7, 8, 9 caps, and now today they're all worth, 6 something cap rates. So just on that alone, we made a ton of money, but then they also been cash flow positive for a decade. So, so like if you want to apply something to today, I'd say that if you can make sense of a deal, it's in a location, it's a quality, it's a property you were going to buy before, and you might just need to look at it and go, you know what, the price is down 20%. I'm just going to buy it. Your return will look lower than it did a year ago, but that's because you were assuming you could sell it at a really high valuation, and we're borrowing at a way lower interest rate.
So I keep, when you were talking about 2008, I kept hearing like very similar stories. I mean, banks failing and stuff like that. You were talking about getting your loan and said, oh, I'm wondering if Wells Fargo is going to go bankrupt and all that kind of stuff, or is going to be out of business. And now here we are. We have like Silicon Valley. We have First Republic that are being bought. And then you're kind of thinking, what other regional bank am I gonna get my loan from, or credit union, and are they going to be in trouble? And what happens if they get in trouble? Like I go through the process and they say, you know what, we can't lend you. And so then you're kind of stuck. You have to find another bank. It's getting harder and harder to get the loans that you want. So that's
going to have a further negative impact on values and everything in the real estate and the whole economy. If if we have more of a credit crunch than we've already had, and that's one thing where when I a lot of times I like to tell people why multifamily is the best to invest in, but if you're in these deal sizes where you can access the Fannie and Freddie, like they're not slowing down. They're the biggest lender in the space, and they're continuing to lend. Everybody's using Fannie and Freddie and that, to finance or multifamily refinances and acquisitions, and that's not available to the other product types. So if you're looking at commercial property, like that's a big advantage of multifamily. There's a lot of other ones, but that's one that I always come back to, and that's sort of their mission is, to the Fannie and Freddie have affordable housing and provide stability to the housing market, and they do that because right now there's probably multifamily projects starting where they're saying, let's get it going, to build it, and worst case we'll just do a Fannie loan at the end. Where if that's an industrial deal or retail, maybe they're saying, I don't know, this loan looks bad, and we'll probably get a bad one on the backside of this too unless something changes. So and then that project doesn't happen, and less supply drives up the prices, So you've done a lot of also deals for shopping center, retail, and I think you did office also, buildings. And I know you kind of moved out of that, and now you're doing more like multifamily, smaller multifamily. So what do you recommend? So now that we almost have a crystal ball right now. I mean, we already know that, this looks very similar to something that happened in the past, and it's kind of going down that path. And it sounds like this might be an opportunity to buy something now, and then in the back end have a very good, a solid real estate investment. But when we're looking at all these different categories, which
is it worth looking at shopping center, retail? Is it worth looking at office space, storage, or anything else, or really focus on the multifamily, the smaller multifamily?
Well, I mean, I focus on multifamily, so it's easy for me to say why multifamily is,
Yeah.
the best, which I'm happy to do. But I think if,
But
first, like,
are you thinking back and say, oh, maybe I should go back to office, or I should go back to, this is also a good time for me to go back to retail?
actually, no, because one thing that I went back and looked at was we got our hands on some NCREIF data, and so NCREIF is a trade group, and they have an index on the returns for private real estate, and they have it by product type. So then it seemed like multifamily always went up the most, but I didn't have anything to back it up. But we got the data from 1990 to 2020, so
Yeah.
30 years of data, and then we calculated all the possible return scenarios for different hold periods. So for 3 years of ownership, 5 year, 7 year, 10 year hold periods. And multifamily had the highest returns for every scenario. And it also had the lowest risk for every scenario except for one, where I think either retail or industrial had a lower risk, but also lower return. So multifamily basically had the highest returns and the lowest risk the last 30 years. And I don't see anything changing with that, where if anything, the tailwinds for multifamily are stronger, where there's, more people working from home. There's more, people coming into the rental market, where, you have all these tailwinds where current renters are renting longer. Home ownership is getting just so expensive, and with higher interest rates, it's going to make it harder to buy.
Yeah.
And then, Gen Z, people born between what is that, like 1998 and 2012, that's a third of the population, and they're just getting into the, some of them are just getting into the rental pool. Like a lot of our renters, we see their, birthdays come in, and you're getting some people where, they're born in the 2000s, so there are plenty of them. And so it's that's a big wave of people coming. I really like how diversified the income stream is. So when you're saying, would you go to retail or industrial or another product type right now?
Yeah.
I don't think the payoff is worth the risk, because let's say, you have a 3-tenant shopping center, you lose a tenant, that building is not making money now. And then
Yeah.
you're going to need to add money to re-tenant it, to pay your broker that did the leasing, the tenant's broker, get the space ready for them, give them a money to help build out their space, a tenant. So that's called tenant allowance. So I'm not a fan of how lumpy like the cash
Yeah.
flows are in those deals. And then also the returns haven't been higher. I mean, sure, could you find a deal that has a unique opportunity where it's half empty, you can fill it up and sell it for a lot more? Sure. And that's what we're doing. We did do some commercial deals in 2015, 2017, even as recent as 2019, and they were more or less that profile. Like this is, we can fill it up and sell it and make money. But in terms of like a broader strategy, no, I think people should be doing multifamily and extending their hold periods. So everything I said about like, this will look like a good time to buy, I don't know if that'll be the case in 2 years, 1 year, 3 years. But by the time you get to 5 years, 7 years, 10 years or longer, this will be a really good buying opportunity. So I would recommend people extend their hold periods. Whatever you normally did before, you own some for 2 or 3 years, like plan on owning this one for 10 years, and then start buying nicer quality assets. So as when the economy, as having a nicer quality deal, generally you're going to have better tenants in it that have better jobs, stronger personal balance sheets, higher incomes, and less capex. It's a newer, nicer deal. It's in a better location. So I would think about the risks today, and whatever you could do to de-risk. So then multifamily had the lowest risk in our calculations and highest returns in the NCREIF data. And then also just has a lot less needs to throw in money, or a chance where your building could be, half empty, where you buy a 10-unit apartment deal, probably you're going to have 8, 9, or 10 units full at all times. So it's not that hard to re-rent an apartment too. So,
Yeah.
I mean, that's what I'd recommend to people: trade up in quality, extend your hold period, think about the risks.
For me, like on multifamily, I mean, I used to have like a few smaller multifamily, less than 20 units per apartment building, and it was a very good investment. It was all value add, and then we ended up that we got some crazy offer, and we said, okay, you wanted this bad. Now we're left with one, and it's doing, it's a great investment. It's it's appreciating and all that good stuff. But what I'm saying is that also is that the millennials are going into family formation. The Gen Z is also kind of at that stage where, am I going to go in an apartment or am I going to go into a single family rental? So some of them are in that family formation. And if they are living at home, they want to go into a single family rental to raise their kids and have their dog run around in the backyard. If they're living in an apartment, they want the same thing. They want to kind of like, go into that single family rental to start their family. So I'm seeing a shift there. And then the other thing too that I saw a shift, and I don't know if this impact or this, the fear of the pandemic caused that, but I mean, it was much easier for me to rent single family during the pandemic than it was to rent apartment buildings. As soon as we had a single family home that was available for rent, we would have like, crazy number of people that would show up to rent that house. We had like 20, 30, 40 people show up, and we had availability in an apartment building, but then people didn't want to really go there. So I think there's still that stigma from the pandemic, and I think that family formation dynamic that I'm not sure how it's going to pan out. So, but so how do you see the future of that? The multifamily, you think it's still going to be very strong for rentals, obviously. How do you think it's going to pan out with the single family rental? What's your point of view on these two kind of asset classes?
Yeah, I think what's interesting for yourself, what you've done, you've essentially created an apartment portfolio for yourself where it's hundreds of units. It's just they're 100, hundreds of houses, and so so that makes sense as an investment strategy, what you've done. I think that, a lot of people have, I would say it depends on the market, because two things in these markets that are really growing, and it hasn't been as big of a factor in the ones that I think you had previously told me you invested in, like Memphis and St. Louis and these places. But in a lot of the places that are booming, let's say Florida, Texas, Arizona, there's a lot of BTR communities being built, which stands for build to rent, where they're building, they're like detached apartments. They call them houses, but it's not like might have a shared yard on the side or whatnot. But so there's more product coming to compete with that, let's say, in some markets, not in all. And so that's like a potential headwind. And then I think it's market dependent, where in a lot of where we invest, Phoenix, Dallas, and Austin, Texas, there's a pretty big spread between what you would pay in a house and an apartment in the same area in all those places, where I think, in Austin, it's like in a lot of these places, it feels like an apartment would rent for around $1,500, and to buy a house is 600,000 plus. So it's not, it'll depend on the market, but I would definitely, I think for the markets you're in, I think your strategy makes a lot of sense. And I think there's kind of room for both to coexist, where there's just still like a price difference. And I think, maybe the people investing in the nicest apartments, the Class A type stuff, where your rents are approaching what you could just rent a house from, then that's going to just be a decision for the renter. Like, what do I value? Like amenities, because there's a pool and a gym and probably underground parking, or, and a parking garage and all that. And someone to pick up my packages for me, or you just more space and privacy. And that's going to come down to the person. Personally, I would rather, live in a house and just have more space and privacy, and less, even if it was older, if it was like a similar price.
For me, like, I'd rather be in an apartment, luxury apartment with all the amenities and all that. Low maintenance. And that's what I do. I mean, I rent here. I love it. Great view. I wouldn't get that in a single family home. So I really like that.
Yeah, so to each their own. It's funny where you invest in the houses, but are in an apartment. It's funny. I'm invested in apartments, and I'm in the house. So
that's right.
So it's
So I get to your point about the multifamily, when it's a little bit higher price point, a higher category. You attract different people. And for me, like, if people are thinking of buying a house at $500,000 or more, they should really consider also renting instead of buying, and investing that down payment into. So just run the numbers and see if you can find something for rent for the same value. And then instead of putting that down payment in the house, is take that and invest it somewhere else. So this is something that's people are kind of they think about, oh, I need to buy my house because that's, that's a great investment. No, I'm still investing in real estate. I just don't invest in my property that I can't deduct as many things as I can, and
Yeah.
it's cash flowing, so.
Yeah, I'll tell you my personal situation then, because this is exactly that. So I moved to Austin, Texas,
Yeah.
actually 2 weeks ago as we're recording this,
Oh,
and
wow.
I'm renting a house, and they had it for sale. They were trying to sell it for $1.7 million.
Mhm.
They didn't get that. They got offers in the $1.6 million and decided to keep it.
Yeah.
In Texas, if you have a normal sized mortgage, let's say, and property taxes are around 2% in the Austin area, I mean, that's easily 10 to 12,000 a month to
Yeah.
own the house. I'm renting it for $5,700.
Exactly.
So, so I'm not building any equity, if the market recovers and the guy can sell it for 2 million, he's going to make all that money. But, month to month, I'm saving. And at least for me, I like that, because I'm moving here. I want to figure out where I want to be exactly. And then I'll buy. But I don't think people make it seem like you need to buy,
Yeah.
you need to buy, where I think long term, yeah, that's a great way to, not have your housing prices increase that much, because you hopefully get a fixed rate mortgage and can get it paid off eventually. But yeah, in terms of like a strategy, like you're saying, yeah, if I just that $5,000 I'm saving, if I just put that towards, leasing a Ferrari or something, sure, like that's just a total waste. But
Oh, that's a complete waste of money.
I'm investing it, in
Yeah.
apartment buildings. So
Yeah,
I think I am
exactly.
gonna, come out well on the other side of that trade.
Yeah, I mean,
So
yeah, exactly. This is exactly right. People say, well, you should really invest. You should invest real estate. Investing in real estate is great. Yeah, I invest in real estate. That's what I
right.
do. But buying a house is not investing in real estate. It's not an investment, for many reasons, because of the way you're seeing that house, how you're putting money into the house, and a lot of the maintenance, all the stuff is not tax deductible, at the end of
Yeah,
it.
I see home ownership is really more of like you're able to sort of get your cost fixed more
Yeah.
so,
Yeah.
where my rent could be jacked next year. I don't have any control of that.
Yeah.
Where if I owned it, I have a fixed rate mortgage, and really the only things that are going to change are insurance, taxes, utilities. But as I get this house paid down, I
Repairs.
could refi, have a smaller payment, eventually pay it off. So I think
Yeah.
it makes sense when you think but it's not like it's not the highest returning investment out there. But if you want to add more certainty to your life and what your housing costs are, I mean, that makes a lot of sense. But I view it more through that lens. Like, you'll invest in the home more. Like,
Yeah.
if you can't see me, I'm sitting in
Oh,
a room that's
exactly.
painted. It's just painted white. Maybe if I owned it, I would have painted the wall behind me blue or something.
Yeah.
But
Yeah.
it's anyways, yeah.
Well,
So no, I
if
view
you
it.
want, Drew, I can talk to your landlord, and I'm sure you can paint it blue as long as you paint
Yeah.
it black, white, as long as you paint it back to white after you're done. That's not
Yeah, no, he's super nice. I'm sure he's fine with it. And then, but I'm sort of just joking. I've only been here two
yeah.
weeks, so I need
I don't
to,
know.
unpack some boxes first before we.
Yeah, so I mean, so that's very good. So a couple of things here. So now people say, okay, well, yeah, I totally agree with Drew. I think this is such a great opportunity. We're at 2008 ish kind of situation. I have almost a crystal ball. I know things are going to be better in a few years. I want to invest in smaller multifamily. Where do I do that? Which market? You already told us, kind of like Phoenix, Dallas, and Austin. This is where you're investing. Any other markets that would be of interest? And then kind of like, how do you find your deals?
Yeah, for the markets of interest, I think if this is helpful for people, we did a uh, a study where we calculated predicted returns in all the different markets, so like at the top, let's say 50 size markets in the country, and figured out what was correlated with price appreciation. And then the top two things were population and job growth. And so as a percentage of the growth, not just raw numbers.
Yeah.
So I think, that's kind of an obvious insight, but we actually, confirm that. And one of the things that wasn't that correlated, it was some interesting insights where like new supply wasn't that correlated with how the prices changed.
Okay.
And so I would just view it through that lens. So yeah, we've chosen, Dallas and Austin and Phoenix for real specific reasons where Arizona has the best property tax laws in the entire country. They have a 5% assessed value increase cap. So you're in a high growth market and you have the most favorable property tax laws in the entire country in any growth market. And that doesn't even change when you sell. California's got really favorable property tax laws, but then when you sell it, they raise it to the new market value.
Exactly.
In Arizona, they don't even do that. So what your taxes are, and they're very low. I mean, we bought like a deal that's $26 million a couple of years ago, and our taxes are like 40, 50 grand on that thing. It's like peanuts. Where I have a deal the same size in Chicago and our taxes are 550,000 a year. Wow. So it's and then in Dallas, that's a very stable market. When you go back and look at the return volatility and the rents and what they did in the last, and home prices in Dallas and then also in Austin in 2008 through 2010, they only dropped 10 to 12%. Whereas in some of these other places, they had dropped 50%. But there's other growth markets that are good. I mean, Florida, that's going to perform really well. Miami is just like a New York 2.0 now. So Miami, Tampa, Orlando, Jacksonville, those are all really highly scoring in our calculations, and back it up with the population and job growth. And then Nashville, Charlotte, Raleigh, like those I all like. Sort of the mountain region that had a lot of growth, and so that's gotten expensive. So I think that's a headwind to further growth in, let's say, in Salt Lake City or Denver. And then the Midwest, and one thing too, like a lot of this is priced in though. So it's, even if you're in, the Midwest, you make more money day one on those deals. You're banking less on appreciation and more just on like immediate cash flow. And I don't think there's anything wrong with that. Like on the deals you buy the houses, like it has a lot of cash flow, and that you don't have to wait for appreciation. You're getting paid right away. So that's the markets we like. That's why we're in those. And then I think there were two parts of the question: what to do today, or how to invest, or
how do you find the deals?
So 80% of the deals I bought have been either off market through a broker, or a repeat seller. So I know a lot of people that buy the individual homes and they do flips or different things, and they do a lot of direct to seller outreach. But on the deal sizes that we're buying, there's not that many. We do cold call owners and try to get a relationship going, but almost everybody sells through a broker. They've realized that you do get a higher price through a broker on these deals. Like they create a market, people have to bid on it, and they get a higher price. So most of the deals we buy, there's a broker involved, but ideally it's not widely marketed. We're not doing a best and final call for offers. 10 people are bidding on it. A lot of the best deals I bought, it's like we've already bought with that broker before, and they know it's a type of deal we buy. They know we're closers. We don't mess around and try to change the price on people if we find little flaws in the property, or or hassle them. And so most of the deals are done that way. I'd like to do more direct to seller outreach, but 99.9% of the time it's just them saying, yeah, I do, like I'm good, I don't need to talk, or I have a deal, but I'm going to sell it with this broker. Thanks for just talk to them. So
build a relationship with the broker. You might have access to more than one property. So that makes a lot of sense.
And be known as a closer. It's easy to look at a property and go, oh, this is the roof's not brand new and this and that, and the furnace is 10 years old and I want some money now from the seller. But when you went to the property, you saw that stuff wasn't new, and you need to have that factored in your numbers. Where I don't buy any deals and assume there's every deal I buy, to not say it with a double negative, I assume there's money that we're putting in day one, CapEx, even if it's a brand new building. On the deal sizes we buy, I don't assume anything less than 50 grand, where there's always something. We bought brand new buildings, and you're still doing stuff that they didn't finish all the way.
And in fact, the apartment buildings that we bought, it's actually a broker that approached us, and then a couple of brokers that approached us, and because they knew that we were doing a ton of single family rental flips in the area, and we were known, and then they said, these guys are closer. They're really doing a lot of investing here in the area. Maybe I'll ask them if they're interested in an apartment building, and that's how that relationship got built. And we bought like 3 apartment buildings with one broker, and then 2 other ones with actually the existing seller. that had more properties to sell. So that worked out very well. And so
That's exactly right.
So I think that makes a lot of sense. I know a lot of people are trying to talk to the seller directly and owners and all of that. And yeah, you're trying to build a lot of relationship at the same time. It's time consuming. It works for them, and that's good, but it's just a different approach. And so I like that. I like that a lot better. It's a lot less intensive. Just build a relationship with a few brokers, and they know what's going on in the market. They can bring you the right deals.
Yeah, and as you get into larger deals, it's really driven by the brokers. Like I would, even as I get into bigger deals, I would assume there's no $100 million deals where it's like a cold call. We just call the Blackstone. Like, yeah, that's cool. We'll sell it to you. It's fine. Like, no, they'll sell it with the broker they bought it with 9 times out of 10.
Yeah,
to make that broker happy, and then also get the highest price.
Yeah.
So because then they'll say you can just bid on it when we sell, and then they're pushing. We're pushing our numbers potentially because we know other people are bidding. So like that's just normal mentality when you're bidding on something other people are bidding as well.
Exactly. Well, Drew, it was a pleasure speaking with you. I think I hope that we kind of encourage people that don't be too scared about the real estate market, because I think like 5 years or 10 years down the road, we're going to look back at people that bought real estate and this year, and they're going to say, well, of course, it was a no-brainer in 2023. This was everybody, knew this would happen. No, we are in here now. We are at the crux right now. This is the time to really look at some real estate investment and buy the right investment. But 10 years down the road, people are going to be looking back and say, oh yeah, this I should have bought. So Drew, if people want to if people want to reach out to you, how do they reach out to you?
Yeah, I think probably best way is on LinkedIn. Just type in Drew Breneman. Last name is B as in boy, Reneman. I'm also on Twitter with the same, just with my name. Or really all social media with that. I also have a podcast, like you mentioned, the Breneman Blueprint. We get more into just multifamily investing and just investing in real estate in general.
Yeah.
And then if you want to invest in our deals, we have passive investors as individuals, accredited investors invest in our multifamily real estate opportunities. I think it kind of fits in well with what you do, where if you want like full control and just buy buy the property yourself and then hire out the management, I think like you have a really good option for people if they want to do, but you still have to buy the property and oversee the management. If you want to do zero work and just throw money into deals and get exposure to private real estate, that's where we fit in. Like, so if that's more your speed, where you're okay with someone else calling the shots and making the decisions and you're along for the ride. I mean, we have a really good track record, 25% IRR on sold deals. So we know what we're doing, but it's more of a thing of you send in your money when the deals come out, you sign your name on the documents, and then you just hang out for distributions. You don't have to actually do anything. So that's my goal. Hopefully I'll be in.
Yeah, that's Breneman Capital, right? Yeah, the website.
Right. Okay. Yeah, Breneman.com.
Okay.
Everything's
excellent.
there.
So yeah, I'll put the links in the description. And Drew, it was a pleasure speaking with you.
Thanks. Great being on. Appreciate it.
All right. And make sure you like and subscribe, and see you next week.
Thank you for listening to Break Away from the Rat Race with your host, Eric Martel. If you want to share your story and experience with our listeners, please message us on Facebook at Break Away from the Rat Race. Also, please subscribe to our YouTube channel and our podcast on iTunes.